Hello, welcome to the seventh module of cryptocurrency management course. I will be looking at building mentality strength in cryptocurrency trading. Building mentality strength in cryptocurrency trading. We will have an understanding under this module of psychology of trading and how emotion drives decision. We will also look at emotional intelligence, that is how to manage fear, greed, and stress. Also, we will implement strategies for managing trade losses and coping with volatility. Um, we also overcome destructive behavior like FOMO and panic selling. FOMO is fear of missing out, and also we will look at we cultivate core virtue like discipline and patience. Also build long-term trading resilience, and we also look at stress management techniques. And lastly, we will look at personal trading uh, plans. When we talk about the psychology of crypto trading, you need to firstly understand that the mind is your most powerful tool and also a biggest risk. And the psychology of cryptocurrency trade refers to the study of how human emotions, cognitive biases, and behavioral patterns influence decision making in the cryptocurrency market. Unlike traditional investments, cryptocurrencies are highly volatile, often experiencing rapid and unpredictable price fluctuation, which can trigger emotional reactions that impact judgment. And the problem is crypto's extreme volatility triggers primal emotional responses that can override logic. And key psychological pitfall that we see while trading in crypto include fear and greed. And these two forces um, there are two forces that drives the market. Fear can cause panic selling, while greed can cause reckless buying. And another pitfall is loss aversion. That is, the pain of a loss feels twice as powerful as the pleasure of a gain. And this leads to holding losing position for too long. And also, another pitfall is herd mentality, and this is actually the urge to follow the crowd, leading to buying tops and selling bottom. And another is overconfidence, which is a string of win can lead to taking on excessive risk, ignoring your own rules. We have the emotional intelligence in trading. And when we talk about this, it is actually the ability to recognize, understand, and also manage emotions and the emotions of others in crypto currency trading. And emotional intelligence is critical for making rational financial decisions, maintaining discipline, and also managing stress in a volatile market environment. We have the five pillars of emotional intelligence for traders, and the first is self awareness, that is, recognizing the emotional triggers. For example, I feel anxious when the price drops 5%. And another pillar is the self regulation, that is, the ability to be able to pause and choose a rational response instead of an impulse reaction. Another pillar is the motivation, and for this, we talk about staying focused on long term goals despite short term setbacks. And another is empathy, and for this, we talk about understanding the um, market's collective sentiment, that is fear or greed, to be able to anticipate moves. And lastly, on the pillar of emotional intelligence is social skill, that is communicating clearly with peers or clients, especially during stressful times. Now, looking at managing the trade losses, which is actually inevitable. Managing trade losses is an essential skill for cryptocurrency traders, as losses are an inevitable part of the trading in highly volatile market, and how a trader responds to losses often determines long-term success or failure. Proper management ensures that losses do not escalate into catastrophic financial output, or outcome, and that emotional reactions do not undermine rational decision making. The mindset shift is actually that you accept that losses are a guaranteed part of trading, and the goal is not to avoid them but to manage them. So you need to change your mindset onto understanding that losses are guaranteed part of trading, and also the goal is not to actually avoid losses but to actually manage losses. And strategies for managing losses include acceptance, that is, view losses as feedback and data, and not as a personal failure. Also, to manage it, you need to have a predefined risk. That is, you use stop losses to ensure a single loss doesn't devastate your account. Also, you need to analyze and don't agonize. You review the losses. Was it a bad trade or a bad luck? Learn the lesson. And lastly, no revenge trading. Never try to immediately win back lost money. Yes, this leads to impulsive, oversized, and emotional bets. In coping with market volatility, volatility is actually not just risk, it is an opportunity. It is also an opportunity. And the key is having the right mindset and tools. And how to cope with this is to one, zoom out, shift your focus from the 5 minutes chart to a daily or weekly chart. Long term trends are often clear despite short term noises. And second is that you stick to the plan. Your trading plan was built for this condition. Trust its rules, and also use volatility to your advantage. As scalpers or swing traders, volatility creates the price movement they need to profit, and for long-term investors, dips are buying opportunities. And you need to stay informed, not overwhelmed, and you need to know the news, but don't let every headline trigger a reaction. Let's look at the enemy within. We talk about fear of missing out, and when we talk about fear of missing out, it's actually common psychological challenge in cryptocurrency trading, which is triggered when traders feel pressure to enter a trade because others appears to be profiting, and the result is buying at the top of a pump and right before it crash. And the antidote is uh, there will always be another trade. Stick to your plan. Choose strategy, not price. Another enemy is the panic selling. And what is panic selling? It occurs when traders sell their cryptocurrency holdings impulsively during a market downturn, often driven by fear, uncertainty, or herd behavior. And the result is locking in a loss and missing the eventual recovery. The antidote is that you trust your plan. If you if your stop loss isn't it, your thesis may still be valid. um, Zoom out and assess calmly. So it's more on your plan. That is why you need to work on setting a perfect personal plan. So looking at discipline and patience. Discipline and patience are essential traits for successful cryptocurrency trading in a market known for rapid prices. Changes, impulsive decision of often result in financial losses. So traders who cultivate discipline and patience are better able to adhere to their strategies, resist emotional impulses, and also achieve consistent long-term results. And the first, when we look at discipline, it's actually doing the work. You need to be disciplined to follow your trading rules even when it's boring or scary. You need to be disciplined to take profit when your target is hit, even if it looks like it could go higher. You need to be disciplined to cut losses when your stop loss is triggered without hesitation. Also, you need to be patient. That is, when we talk about patience, it is waiting for the right moment. You need to be patient at waiting for your specific high probability setup to appear. Also, you need to be patient, not forcing a trade just to be in the market. And you need to also be patient to also understand the cash is a position, that cash is a position. Waiting is a valid strategy. Now, looking at building long-term trading resilience. When we talk about resilience, it is actually the ability to bounce back from setbacks, failures, and also adapt to changing market conditions. And how to build it is you learn from losses, you diversify your portfolio, you also follow risk management, you continue to learn. The market evolves, so you should also continue to evolve. You need to continue to learn, stay educated. Uh, Staying educated reduces uncertainty. So, and also you need to focus on process, not profit. You need to focus on process, not profit. You judge your success by how well you followed your plan, not by the day's profit and loss. Good job leads to long-term profits. Looking at stress management techniques, it's actually trading is actually inherently stressful due to the market high volatility, rapid price swing, and also unpredictability. Effective stress management is essential to be able to maintain clear thinking, make rational decisions, and also preserve both mental and financial well-being. And also, stress clouds judgment. Managing it is a core trading skill, and effective techniques in managing stress includes mindfulness and meditation. That is, even 5 to 10 minutes a day can improve focus and reduce reactivity. Also, physical activity is very important. Is another technique, that is exercise. You need to exercise, you burn off stress hormones and clear the mind. Also, you another technique is a scheduled break, that is stay away from the screen. Information overload leads to bad decision. Also, another technique is emotional journaling. Write down how you felt during trades. This helps identify triggers and patterns. And lastly, healthy lifestyle, sleep, nutrition, and hydration are the foundation of emotional stability. Now, in developing a personal trading plan, it's actually a structured roadmap that guides a trader's decision, risk management, and also strategies in the cryptocurrency market. And it serves as a blueprint for consistent discipline and rational trading, reducing the influence of emotion and improving the livelihood of long-term profitability. And a written plan removes ambiguity and forced discipline, and it is your rule book for when emotion runs high. And key um, elements of your plan should include goals. What are you trying to achieve? Maybe 15% annual returns or income generation. Market assets. What will you trade? Which are you trading? Bitcoin, Ethereum, or top 10 altcoin? Another element is the strategy, which is your hedge. You using swing trading breakouts, the long term, or whatsoever. And you need to also uh, look into the risk management maximum, which is maximum risk per trade, the percentage of total income that you can risk, and the stop loss rule. Where will you get out of the trade if it's actually at loss? And the entry or exit criteria also is important, looking at what specific conditions must be met to enter a trade. When will you take profit? And lastly is the review schedule. When will you review your performance, weekly or monthly? The daily practice, that is the trading journal. A trading journal is not just for tracking numbers, it is for tracking you. What you log for every day. It's actually what you log for every day. I mean, what you log for every day includes the trade, which is asset size, entry, exit, profit and loss. Also, you log for the strategy. Why did you enter? You also log for the emotion. How were you feeling? And lastly, the lesson. What did you trade? This trade teach you? Reviewing your journal helps you to be able to connect emotional patterns with trading outcomes. In conclusion, this module has been able to actually equip you with the psychological toolkit to complement your technical skill. You now understand that the market is a mirror reflecting your own fear and greed. Your keys to success include acknowledging your emotion, plan your trade your plan, manage risk to manage emotions. Patience and discipline are key in trading. Resilience is built, not born. I have this final thought for you. In the end, you aren't trading the market, you are trading your own beliefs about the market. Make sure those beliefs are rooted in strategy and discipline, not fear and greed.